All right, hedge funds are outperforming their benchmark indexes after their worst year in 2008, and they're attracting new assets for the first time since last June. Investors who don't have the money, though, to buy into these funds might consider a couple of new ETFs that are designed to mimic hedge fund strategies. The IQ Hedge Multi-Strategy ETF uses several hedge fund investment styles, including a long-short equity, market-neutral, and fixed-income arbitrage, to name a few. The IQ Hedge Macro Tracker ETF, which debuted on June 9th, focuses on emerging market investments. Adam Patti, the CEO of IndexIQ, which developed these ETFs, joins us now. And, I didn't explain all of what these products do, but it's good that you're here because you can help us out with that. Let's talk, though, first of all, about hedge fund replication. Been around for 10 years. Why don't you just explain to us exactly what it is that these ETFs do?
Sure. Thanks for having me. Look, it's pretty straightforward. In 1984, there were around 84 hedge funds, if you can believe it, back then. Now you've got over 9,000 hedge fund managers out there. So when you can imagine when you have 9,000 hedge fund managers are going after those same market inefficiencies, trying to drive alpha, what in essence they're doing is competing away those inefficiencies. So what's been proven is that hedge fund performance in aggregate is actually a form of beta exposure or market exposure rather than the alpha you think you're getting as an investor. Clearly, there are those great hedge fund managers out there that can drive alpha. But in aggregate, you're getting beta exposure. And what's been proven is that you can actually replicate that beta exposure by using liquid securities commonly found in the marketplace. In our case, we use ETFs.
Which is a big key here, the fact that you're using liquid securities. Why is that so important?
Well, I mean, liquidity is key, and we all learned that as investors over the last 12 months, that liquidity and transparency are probably more important than fees. In our case, we focus on all three, really providing the risk-return characteristics of hedge fund investing, but without the structural impediments of investing in an actual hedge fund, namely the high fees, the lack of transparency, and the lack of liquidity.
So you have a couple of products that are basically ETFs of ETFs in order to do this. You charge 75 basis points management fee. Let's talk about the first one. It pools 6 hedge fund strategies and wraps them into one of the tickers QAI.
That's right. That was our first. It debuted on March 25th. It's more of a multi-strategy strategy. It's a fund of funds of 6 underlying hedge fund strategies. Those 6 strategies that underlie that product comprise around 85 to 90% of overall hedge fund assets. So it's a good way as a core holding for your alternative exposure.
Does it concern you? I mean, we have seen an inflow now into hedge funds for the first month in 11 months, but we did see in the first quarter, for example, 200 fund-of-funds hedge funds shut down out of 332, so
Yep.
They were the hardest hit.
Yep. Well, exactly. I mean, I think because fund-to-funds charge extra fees on top of the typical 2 and 20 that a hedge fund would provide for due diligence. And in essence, what they're providing is this beta exposure. And you know what? A lot of them provided due diligence and still ended up with some of those bad hedge funds that ended up going under.
And you can do it without the 2 and 20 charge there. Let me ask about the second one. MCRO is the ticker, and that's the first hedged emerging markets ETF.
Very excited about that. Look, emerging markets have had a great run. Many savvy investors believe that emerging markets are leading our way out of the recession. The problem with emerging markets investing is that you're in for a wild ride, very volatile. Big highs, big lows.
And it should be pointed out that you're trying to mimic the returns of hedge funds. So you're not necessarily trying to beat hedge fund returns, although you did in the first month for your first ETF. You want to mimic them or come as close as you can.
Exactly. Provide the diversification benefits of hedge funds with transparency, liquidity, and low fees.
Is it a concern? Hedge funds have a minimum investment not only because they want to raise a lot of money, but also they want sophisticated investors. So I'm guessing you could have normal investors come and maybe make some mistakes with your products.
Well, the mistakes would be few. I mean, it's a very liquid vehicle. You can get in and out of it on a daily basis. But that's a big problem. The access issues into hedge funds is an issue. Why should only the most sophisticated investors have access to the diversification benefits of hedge funds?
All right, so you got $100 million in assets now in those 2 ETFs and a hedge fund and a mutual fund. What's your goal? Where are you going to go?
Well, actually, the $100 million is across the company, across our different product categories. Look, we're looking to build the vanguard of alternative investing. So we've got a long way to go, but we've got a great start.
All right, Adam, thanks very much for joining us. Hopefully we'll do this again, and we'll see how it's going.